Morning, we're just going to give it a second. There you go. Good morning. We're just going to give it a second to let everybody enter into the webinar, and then we'll begin our session. Okay, I think we're ready to start. Thanks for joining the Ethos Human Capital Solutions webinar today, entitled Secure 2.0, What Employers Need to Know About the Changes to Retirement Plans. My name is Denise Ketty, and I am your moderator for this session. I'm going to go over a few housekeeping notes today before I introduce our expert panel. The webinar will run about 55 to 60 minutes. We'll save some time at the end for Q&A. Don't worry if you need to leave the webinar before the end. We will have this posted on the Ethos YouTube channel probably later on today. The link to the handout was included in the email confirmation you received earlier today. If you did not get it, please drop some information in the Q&A section and I'll get that to you. Oh, and there it is right there. If you have questions during the presentation, please post them to the Q&A area on the dashboard at any time during the presentation. If you'd like your question directed to a specific panelist, to Linda or to Christine, please denote that in the question. Just a reminder that today's webinar is being recorded and all accompanying materials are protected by copyright. The presentation today is intended for information purposes only and should not be relied on to reach a conclusion in any area of law. The information is offered during the webinar as of today, May 11th, 2023. As always, we recommend you consult your professionals to address any specific situations that you are working on. This webinar has been approved for 1 HRCI credit. If you're certified through HRCI and want a credit for today's attendance, type HRCI into the question section on your dashboard, and we'll send you an evaluation and a certificate of attendance once you've completed the evaluation. Let me introduce today.
Let me stop you right there for a second.
Yes. Yep.
Don't bother typing it in the Q&A. Just use this link, and it's also in the presentation handout at the end as well. And it will be in the follow-up email that goes out. So we'd like everyone to complete the survey. If you need HRCI credit, definitely complete the survey, and that will drive you to a link where you can download the certificate.
Great. Automation is coming to us. Okay, let's introduce, let me introduce the first speaker and host of our webinar today, Linda Duffy. Linda Duffy is the founder and president of Ethos Human Capital Solution, and she is known as the people problem solver. Linda and her team are known for building the magic of the human connection with their consulting, recruiting, and training and organizational development programs. Linda and her team work with your company by developing strategies for business leaders to get the right systems, people, and culture in place within your organization so you can focus on running your business and achieving your goals. Her clients range from high-tech businesses to manufacturing firms to nonprofit organizations, and Linda is extremely well-versed in addressing the concerns of founder, CEO-led businesses. Linda, would you introduce our speaker today?
I shall. Thank you so much, Denise. I always appreciate your help. I am very excited today to have Christine Roberts with us. I met Christine through a business networking group called Provisors, and I was super impressed with all of her knowledge. She is an employment attorney, but she has a very specific niche expertise in ERISA law. And so ERISA is a federal law that covers all sorts of employee benefits. So she keeps up to date on this. So we're so happy to have her here so she can sort of break down this 300+ pages of nonsense that the government came out with. And she assures me that she can dumb it down so even people like myself can understand her. Christine, as you saw, can see here, received her undergraduate degree from Wellesley and then got her JD from UCLA. Little personal note about Christine, she and her husband are big fans of New Orleans and are headed there in June with some friends. She's a little bit of a foodie, so she likes to test out all of those new restaurants in the neighborhoods adjacent to the French Quarter. And she has a Boston Terrier and a rescue Chihuahua. So she's only part of the dog family that Ethos loves so much. Christine, before we get started on this, let's do a quick poll and let's find out. And I don't, bear with us, everybody, because the first time we're trying to launch this. So we'll see what happens. I don't know. Can you guys see the poll? There you go. People are actually responding. So that's awesome. Yay. So what's your company's current retirement situation, right? So this will give Christine a good way to sort of judge how to tailor her comments, although she'll speak to everybody's situation at some point during the presentation. So it looks like, Christine, the people that have answered so far, 90% have a 401k plan in place. And about 5% are in Cal Savers and 5% are thinking about doing putting in a 401k plan.
Okay.
So do you see, I don't know, do you see the answers on the screen?
I don't see the answers, but that's really helpful information for me to gauge the audience's needs.
So let's see if I end the poll. Okay, now I can share the results.
Okay, there we go.
You see that? Okay, perfect.
Yep. Great.
Yay, my first poll. Woo, woo. Okay. So great. So with that, everybody can see the answer to those questions. So we just had 24 people, so about half of our attendees log in, but that'll give you a pretty good idea of what's going on. Okay, and then I'm going to go ahead and let you take over the screen, Christine, and from here on out. And I will just remain in the background and I'll turn off my video. And at the end, we'll circle back for any questions.
Sounds like a plan. Let's go. Let's do this. Okay, I think so it's my turn to share screen.
Yeah, go ahead and share screen. Just take it over.
All right. It just says I can't while someone else is.
Then I will stop sharing.
And I will share mine. Here we go. Thanks, everybody. Okay, so here's what we're going to cover. And we're going to talk about Secure 2.0 provisions for existing plans, which is going to help the vast majority of you who have plans. And we're going to talk about a few provisions for new plans for those of you who are on the fence, don't have a plan yet. We're going to talk about some optional provisions. And we're going to talk about required amendments for 401k plans. And then there's some bonus information at the end. And bear with me here because I just didn't have a chance to practice advancing this. Let's see.
Click on the screen itself, and that should get you back to where you need to be. And then you can see the arrows.
Okay. All right, thanks for that, guys. Okay, so Secure 2.0 is the biggest piece of legislation affecting retirement plans since 2006. It's set forth in the Consolidated Appropriations Act, which was passed at the very end of 2022. There's over 90 provisions affecting 401k plans and other retirement plans, 358 pages of statutory text. And for every page of statutory text, there usually are 10 or more pages of regulations. So you can only imagine how impactful this is to the retirement plan landscape. We'll talk about the effective dates when we talk about the specific provisions. Amendments to 401k plans are generally required by the end of 2025, but that deadline may get pushed out, as we'll discuss. And all we'll talk about today are 401k and other defined contribution or bucket kind of retirement plans. We're not going to talk about pension plans per se. Okay, so here are some of the provisions for people who have plans right now. And the provisions we're talking about at this section are required. So they are going to affect everybody. Secure 1.0 was passed a couple of years ago, and it required plans to cover what they call long-term part-time employees. Forever and a day, the requirement for 401k plans has been that you could require 1,000 hours of service before people would be able to participate. And for the first time under Secure 1.0, the IRS, the government, changed that rule to require employers to let people into plans when they've worked at least 500 hours of service in 3 consecutive years. Now, the only thing they're allowed to do is make elective deferrals under a 401k plan. They aren't automatically allowed to get employer money, but that was Secure 1.0. Secure 2.0 liberalized the rules, requiring 500 hours of service in 2 or more consecutive years, and also expanded this provision to Section 403B plans maintained by nonprofit employers. Okay, so what that's a little bit confusing for one thing, because all of you out there with 401k plans are subject to Secure 1.0, and now you're also subject to Secure 2.0. So what do you do? We'll talk a little bit about how this is going to work. As an example, an employee who works at least 500 hours of service in 2021, 2022, and 2023 should be eligible to make elective deferrals in their employer's 401k plan on January 1, 2024 per Secure 1.0. Okay, so if that same employee were employed by an employer, for instance, with a 403B plan, not subject to Secure 1.0, that employee would be able to join the plan in 2025 if they worked 500 hours of service or more in 2023 and 2024. So basically, you'll have 2 tracks. You'll have people who were there in 2021 with 500 hours or more in that year, and they will have to be able to enter in 2024. And then you'll have other people who you'll be tracking for 2023 and 24, entering in 2025 under Secure 2.0. This is one of those provisions where it's mandatory, you don't have the option to ignore it, and you're going to have to work closely with your record keepers and third-party administrators to make sure these pieces all work in conjunction. So as mentioned, for these long-term part-time employees or LTPTs, you don't have to make employer matching or non-elective contributions. You have to let them make elective deferrals if they meet the 500 hours in the consecutive years requirement. You can use 6-month entry dates or other entry dates. They're not counted for non-discrimination testing of deferrals and match and other non-discrimination or minimum coverage testing rules. So that's helpful. A lot of people ask me, well, can we still have a requirements that like you work at plant A or plant B or location C or be in a particular job description? And the answer to that is that presumably reasonable job-based exclusion criteria that pass minimum coverage testing are still permissible and not preempted by this rule, but we would appreciate more guidance from the IRS. I've been working with retirement plans for 30 years, and I honestly don't see a lot of these job-based exclusion criteria. I see age-based and service-based all within the statutory minimums, and I don't generally see plan populations limited to locations or job descriptions. But if you do have those criteria in your plan and you're wondering how they intersect with these LTPT rules, your best source of advice is your third-party administrator or plan advisor or an ERISA attorney if they aren't able to help you with answers to your questions. Okay, still more on this very impactful provision under Secure 2.0. So what about service? Service for plan years before January 1, 2023 is disregarded for purposes of Secure 2.0 eligibility. But for vesting purposes, it's counted under both Secure Acts since 2021. Now, vesting is only relevant if you have employer money. And as mentioned, you don't have to allow these people to receive employer money. But if you look down at the third bullet point, you really need to track hours of service for vesting purposes, because some of these people may cross over to regular eligible participant status. If you have 1,000 hours, they may meet that criteria. And so you'll want to know when they started accruing vesting service for employer money purposes. So you should already be tracking hours of service starting in 2021 for the 500 or more hours of service per year. Now, some of you may just sort of be twiddling your thumbs because you don't have even 500 hours of service to be eligible to participate. You have 3 months or something else. So bear with us, we're almost done with this part of the presentation. We are done with it. So another provision of Secure 2.0 is that effective in 2024, catch-up contributions for participants who are age 50 or more, and whose wages in the prior year exceeded $145,000 must be in the form of after-tax Roth contributions. And if you don't provide for Roth catch-ups, you have to amend your plan to offer them. And you can permit people who are earning under 145 to make Roth catch-ups, but you don't, it's not mandated. This does not apply to simple IRAs or SEPs, just to 401k or other defined contribution plans. And really, it's only relevant to 401k or 403b plans because those are the ones that have deferrals and catch-ups. So 145 is a number that is not something you track now. So it's another number or threshold you're going to have to work with your third-party administrator or record keeper to track. More new changes to catch-up rules. Effective in 2025, employees who are between ages 60 and 63 will be able to make additional catch-up contribution amounts capped at the higher of $10,000 or 150% of the regular catch-up limit for 2024. Now, the regular catch-up limit for 2023 is already $11,250. 150% is already over $10,000. So this is very common for the government. They plug in these round numbers that are obsolete the minute they use them, and that's the case here. For simple plans, there's a different limit. Since most of you have 401k plans, I won't spend time on that. Once you reach age 64, that enhanced catch-up ability ends and you're back to the regular age 50. And again, if there are people who earn over 145 in the year prior, they're going to have to make catch-ups on an after-tax basis. So this is an example of multiple Secure 2.0 rules sort of interweaving themselves. Okay, RMD is an acronym for required minimum distributions. These are distributions where the government says, okay, you've held on to your deferred, tax deferred growth of retirement savings long enough. You've reached a certain age that we view to be retirement age, and you have to start taking money out. And so they're required over a life expectancy based on actuarial charts. They're applied to traditional IRAs and also to retirement plan accounts. And Roth IRAs are only subject to these rules after the death of the account holder. So for Roth IRAs, these rules apply to beneficiaries. So here are the new ages. If you were born before July 1, 1949, it's the old age that was the age forever and a day, 70 and a half. If you're born in this short window between June 30, 1949 and December 31, 1950, it's 72. That was Secure 1.0. Secure 2.0 brought in the ages 73 and 75. 1951 to 1959, it's 73. 1960 or later, it's 75. There is a glitch in this law. Not surprising, with that many pages of statutory text, they made a few mistakes. If you're born in 1959, the way the law reads now, you have to take distributions at both 73 and 75. That's a mistake. We believe the accurate age is 73. Also, when they cut and paste pieces of the Internal Revenue Code to create Secure 2.0, they accidentally snipped out all of the provisions related to catch-up contributions at age 50. That was something I meant to mention a few slides ago. They took out a healthy organ by accident, and that's something they're going to have to, somehow Congress is going to have to cooperate and tack that onto some must pass spending bill or something to get the catch-up contributions rehabilitated. But they're chugging along. No one's not doing them just because Congress made a mistake in drafting this law. So another thing is, what if you have in-plan Roth accounts? So I just explained a few slides ago that if you have a Roth IRA, you don't have to take RMDs during your life. But if you had a Roth account in your 401k, you did have to take RMDs from the Roth account. That is not going to be the case effective in 2024. You do not have to take RMDs from an in-plan Roth account in a 401k or 403b plan so that they're treated like Roth IRAs. But this only applies in 2024. If you have a Roth IRA account and you're at the applicable age, you have to take those RMDs this year. Okay, so those are some of the provisions for existing plans. I'm going to, not spend too much time on provisions for new plans, although I think for those of you who maybe are consultants and who work with multiple different companies or those of you who may be moving on to new ventures, it's important to know what the options are for new plans because there are quite a few of them and they're really quite impactful. New 401k and new 403b plans adopted after December 29, 2022 have to implement auto-enrollment and auto-escalation in 2025 and subsequent. This also applies to employers that join multiple employer plans or MEPs after December 29, 2022. There's a 3% minimum auto-enrollment start point and it goes up to 10%. And 1% annual auto escalation up to 10 to 15%. And the 10% cap applies until 2025 for non-safe harbor plans. There are rules about being allowed to withdraw your deferrals within a 90-day period if you weren't happy you were auto-enrolled, and obviously you can opt out at any time. And qualified default investment alternatives have to be used for auto contributions. And again, participants can modify their investments at any time. There are some exemptions for these new plan auto enrollment and auto escalation rules, namely small employers, fewer than 10 employees, new businesses, fewer than 3 years, and church and governmental plans and simple plans are exempt. You know, I'm going to sort of sidebar and talk a little bit about policy behind Secure 2.0. One of the main agendas of Secure 2.0 was to expand access to retirement savings. There is a pretty significant retirement savings gap consisting of people who have lower paid jobs especially in industries like construction, retail, hospitality, where pay tends to be kind of depressed and there's high turnover. This affects people of color, this affects marginalized communities, and the government is quite aware of this and is trying to address this with provisions like a long-term part-time employee coverage, with provisions like auto-enrollment and auto-escalation. But if you note, there isn't an instant start for these. The auto-enrollment and auto-escalation doesn't happen for another 2 years. Even the long-term part-time is not happening quite yet under Secure 2.0. It doesn't happen until 2025 in Secure 2.0. And so there is some ramp up on this expansion of access to retirement savings. And at the same time, states are implementing automatic retirement savings plans such as Cal Savers and a few other states like Pennsylvania to capture workers in businesses that don't have their own retirement plans and get them into some sort of retirement savings vehicle. They're usually Roth IRAs. It's usually very small percentages of pay, but it's something. It's not nothing. And there is actually legislation that is brewing in Washington to have auto enrollment at the federal level, to have an automatic retirement plan for people whose employer doesn't sponsor one at the federal level. And the retirement industry is all up in arms and concerned that, this is going to, that a massive, federal government mandate will discourage the promotion of private plans. And even though they are in the retirement plan business, they're sort of upset and worried about a federal mandate for retirement savings. There have been proposed federal mandates for retirement savings in the past, and post Secure 1.0, they didn't work, they didn't get anywhere, and now they're coming up again. So one of the arguments of the retirement industry is, just give Secure 2.0 time to work, give it a couple more years. I mean, if most of these provisions to boost expansion of retirement savings really don't happen for the couple of years, give them a couple of years and look at it in 2026, 2027, look over your shoulder and see how we're doing as a nation. But that's not enough. That's too little too late for some legislators. So just be mindful that you may be hearing more about a federally mandated retirement savings vehicle. And if you already have a retirement plan, it's probably never going to affect you, but it may affect the industry that your retirement plan is in. So that's by way of sort of further explanation for the policy behind Secure 2.0 and the fact that it isn't instant and there's impatience in Washington to accomplish the expansion of retirement savings that this act was meant to achieve, but just over time. Okay, so here's more stuff to try to promote the creation of retirement plans and the expansion of retirement savings to more people. Effective immediately. Employers with up to 50 employees qualify for a 100% tax credit. It used to be 50% under old law, up to $5,000 a year for 3 years for plan startup costs. So record keeping, design consulting, admin expenses, education, etc. Things that would be paid by the employer, and they will then get a tax credit. Employers with up to 50 employees will qualify for a tax credit for actual employer contributions. Think about it. You put money in, you get a tax credit for the money you put in. It's 100% tax credit for employer contributions up to $1,000 per employee, making less than or equal to $100,000 per year. That's indexed. And it's phased out by 25% each year over the next 3 years. An employer obviously can't then deduct the employer contributions they get a tax credit for. That's double dipping, not okay. And they must have at least one non-highly compensated employee to get these tax credits. But here's the government rather, giving money to businesses to start up plans, money in the form of tax credits, which offset your tax payment dollar for dollar, giving money to businesses to not only set the plans up, do education, but also to put money in for employees. Employers with 51 to 100 employees, so pretty sizable businesses now, can still qualify for the 50% tax credit and a reduced credit for the employer contributions. There's lots and lots of charts and finding out where you slot. In retirement advisors who set up new plans have tons of marketing and educational materials on this stuff. I'm not the best source for it. I could help you, but really this is meant to promote the retirement business and the people who are in the business of selling retirement plans, as opposed to fixing them or advising about them, have a lot of information on these credits. One rule is you can't have maintained a qualified plan such as a 401k plan, a SEP, or a simple IRA in the 3 immediately preceding taxable years that covered the same people you're covering with your brand new plan that's going to qualify for the credits. The credits can apply to an employer who newly joins a pre-existing multiple employer plan or pooled employer plan. And the employer has to first be out of pocket for the costs for the credit to apply. So you can't charge stuff to the plan and get the credit. Your business has to be out of pocket before the credit will apply. Okay, starter 401k plans. They're trying to create a vehicle that's somewhere between a full-blown regular 401k plan and a simple SEP. It's called a starter K. And effective in 2024, it's a deferral only safe harbor 401k plan, and the employer can't have any other qualified plan in order to adopt it. There's no deferral, non-discrimination testing, or top heavy test. The deferrals are limited, so it's not the full amount. It's not 22.5 like under a regular plan. It's 6,000 plus an age 50 catch up of 1,000, and those are indexed for inflation. Auto-enrollment has to be a feature. It starts at 3% and employees can opt out. And you can qualify for those startup tax credits and have a starter 401k. You can double dip on provisions of Secure 2.0 to get a plan out of the box for your company under whatever circumstances work best for your employee population and your business model. Okay, so those were all changes. The first part, we talked about sort of mandatory changes, and then we talked about provisions for new plans, which obviously are optional because if you don't have a plan, they don't affect you. Now we're going to talk about some optional changes for existing and new plans. Starbucks cards. Up until now, believe it or not, the law has been very specific, Internal Revenue Code, that you could not, the only incentive an employer could give an employee to participate in a 401k plan was an employer match. You couldn't incentivize an employer to be in a 401k plan other than through a match. That has changed. You may now offer a de minimis financial incentive, effective immediately, to an employee for their having enrolled in a 401k plan. The Secure 2.0 does not specify a dollar limit, but we do know that for other tax purposes, $25 is sort of a threshold above that is sort of more something the IRS, it's just under 25 or under, I think is a safe limit. The employer, not the plan, must pay for the incentive. You can't take money out of your 401k plan, go buy a bunch of Starbucks cards and do it that way. You've got to take it out of your own bank account for your company. The incentive will constitute taxable income to the employee, and also make sure your 401k plan excludes gift cards, because otherwise a gift card technically is comp counted in W-2 and counted for purposes of contributions under your plan. And you're going to want to coordinate with your record keeper on rolling out this feature. I mean, you need to coordinate, you know, making sure that only people who actually enroll in the plan get the incentive. You need to make sure your plan excludes gift cards, or that the plan takes into account the gift card comp. The gift card comp is always going to be W-2 income. It doesn't always have to be plan income, depending on how your plan is drafted. But this is, it's surprising what you can get people to do for a couple free cups of coffee or smoothies. And that obviously isn't the only options for gift cards, but I think this is a great idea. I think that it's surprising how impactful that $25 gift card or that $20 gift card could be in someone's future if they really get into a retirement plan at age, say, 25 or 26, instead of just sort of putting it off until they're 35 or 40. So I'm a big fan of this provision of Secure 2.0. Ability to match student loan repayments. What we've seen is that student loan repayment burdens are such a financial weight on employees that they're not enrolling in 401k plans. So the government decided to address that, and effective 2024, employers can make matching contributions on the student loan repayment as if the student loan repayment were a deferral under the plan. So let me repeat that. An employee doesn't defer under the plan. They make a student loan repayment, but they report that to the plan, and the plan treats it as if it were in the plan and makes a match on top of it. So that way employees with student loan burdens don't lose free employer money in the form of a match. Employers may rely on employees' self-certification of their student loan repayments. Has to be for qualified higher education expenses. And the rules permit separate non-discrimination testing of the people who are receiving these matching contributions. So this will not present complications on the non-discrimination testing front, which is desirable. Okay, a few more provisions. So, I mean, I think just going back, this is really important. Student loan repayment duties are very, very severe, and getting someone in the plan, getting somebody starting saving towards retirement, even while they're repaying student loans, is a really important benefit. And, you know, people repay student loans at all stages of life. There's a lot of people who are collecting Social Security and paying student loans. So this is not just for the 20-year-olds. This is for people at all stages of life who are adding education back into the mix. Okay, this is an optional provision. Plans can optionally permit participants to elect to receive employer matching or employer non-elective profit sharing contributions in the form of Roth contributions. So the contributions have to be non-forfeitable when made, so no vesting schedule. And the contributions aren't excludable from gross income. So you're going to have to reflect these after-tax contributions on W-2. This is effective immediately, but obviously administrative measures must be put in place to implement. I mean, right now, I don't know of any 401k plans I work with that allow after-tax employer contributions. And I don't know that Fidelity, Principal, and Empower have rolled out this vehicle yet. So this is maybe concept only, but something that is permitted under Secure, and there will be a certain amount of demand for. People like Roth because they pay the tax up front, they get the money out tax-free, and there may be a desire to use this. I look at a lot, my job is spending a lot of time looking at what people save and don't save and how they save it. And I'll be honest with you, I don't see tons of Roth participation, Roth contribution participation yet, but it's growing, and I think it will continue to grow. And one of the ways they paid for Secure 2.0, you have to pay for legislation now. So to the extent the government is losing money by allowing for more tax deferred retirement savings, they're paying for it by converting a lot of provisions to Roth, because with Roth, the government collects the money as soon as the money goes into the plan. So the Roth features are constant in Secure 2.0, and this is yet another one. Savers match. This is really interesting. The Savers tax credit is a device for lower paid people to get a tax credit. And it is underutilized because you can only use it if you have federal income tax liability. And there's a lot of people whose earnings are just below the level where you have any federal income tax liability, so they can't use the credit. And it's estimated by AARP that only 3.25%, between 3.25 and 5.33% of eligible filers even claimed the Savers credit. This credit's been around forever, and look at what lackluster performance or uptake it's experiencing. It's sort of a fail. I would say it's all respect to the people who promoted it. It's kind of a failed experiment. So effective for tax years beginning after December 31, 2026, Savers credit will be reborn as a Savers matching contribution to be made to employer plans that elect to receive them, or to an IRA by none other than the US government. The government is going to make matching contributions in 2027 and beyond. The match will be equal to 50% of contributions made to the retirement plan or IRA, up to $2,000 per person, with a phase out starting at those earning between $41,000 and $71,000 for married, filing jointly, and lower thresholds for single. How is the government going to find your IRA to make a match? We don't know yet. We've got 4 years to find out. And you can rest assured that there will be cottage industries devoted towards connecting the government with your IRAs and your 401k plans and making this all happen. That is real money going into real accounts, and hopefully will have more material impact than the Savers tax credit has to date. Required, we can only get 2 more topics to cover, and they're pretty quick ones. Required amendments to 401k plans. Well, the dirty secret here is there aren't any yet. Pre-approved 401k plans just went through the 3rd cycle restatement. July 31 of last year was the deadline. Plan amendments to conform to the provisions of Secure 2.0 are not due until the end of the 2025 plan year, but I expect that may get pushed out because there's just so much to absorb. There may be interim good faith amendments that Fidelity and Empower churn out that you have to adopt between now and the big deadline, but we haven't seen them yet. So right now, I'm not aware of any Secure 2.0 pre-approved amendments that are available. One possible amendment that has been suggested is to consider a retroactive amendment to 2022 so that you merge the Secure 1.0 and 2.0 rules for long-term part-time employees. So, anybody who's got 500 or more hours of service for 2 consecutive plan years beginning in 2022 and 2023 will be eligible as of January 1, 2024, and just sort of merge it all together. Can you make a retroactive amendment? Yes, you can, if it's expanding benefits to generally everyone in the plan. This is something, if you want to implement this to simplify, you're going to be, one thing is, if I do this, will I be taking my 401k plan off of its pre-approved format? If it's a self-drafted amendment, yes, but if this is something that your record keeper can offer, like Fidelity or Empower, no, but Fidelity and Empower don't generally put amendments out until they're essentially within the parameters of IRS pre-approved format. So this may be something that's really only available for a self-designed plan. If you have questions about this, talk to your third-party administrator, talk to your record keeper, talk to your ERISA attorney. It's a great idea. I think it would be hard to implement given that almost everybody's on a pre-approved plan and you can only make so many changes to those without losing your reliance on their IRS approval letter. But again, a lot of you may already have a much briefer eligibility period and you're not worried about this. Okay, last topic. Bonus info, changes to Form 5500 reporting. This is not Secure 2.0. This is extra. So if you have 100 or more participants as of the first day of a plan year, you have to, these are retirement plans, you have to get an independent qualified public accountant's opinion about the finances and operation of the plan and attach that to the 5,500. And these cost upward of $8,000 a year to prepare. It's really more like 10, 15, 20, depending on the complexity and the size of your plan. So it's a big deal. And especially for plans that start up and are 100 or more at the outset, they freak out because you're like, wait a minute, I can barely afford to make the match or to have this plan to begin with. And you're telling me now it's going to be $10,000 a year to pay an accountant. So the way the current rules work, to count the 100 participant threshold, you count everyone who's eligible, whether or not they have an account and participate. So if 401k is age 21, 3 months of service, they're eligible and you count them whether they ever defer a dollar or not. So you can imagine for a business that's got a lot of low-paid people who don't participate, they're doing an audit, there may be only 20 accounts in the plan. And they're paying for this audit because they have participants based on eligibility, not actual enrollment. Well, new final regulations from the Department of Labor change that for next year, so that you only count people who actually have plan accounts towards the 100 participants. This will mean a number of plans that currently have to do that IQPA audit won't have to do it. However, the impact of the long-term part-time employee rule will likely bump up actual participant headcount over time. And same for new plans that had auto-enrollment and auto-escalation. Auto-enrollment, you automatically have an actual plan account as soon as you are eligible. So that is a counted person under the new rules. These new rules go into effect for the 2023 plan year, but the first impact will be audit requirements for returns due in 2024. There's this 80-120 rule where if you were a small plan under 100 in the prior year, but you've gone over 100 for this year, you can file the way you did the year before, but the 80-120 count will be based on people with accounts, not just people who are eligible. And there's a whole lot of other changes to the Form 5500, including non-discrimination, some questions they ask you about how you pass non-discrimination testing and plan coverage. So, you know, just be mindful that when you get that intake form from your independent qualified public accountant or your third-party administrator for your Form 5500, there's going to be additional questions. You may not understand what they're there for and want a little support in understanding how to answer them. And you know who to go to your TPA, go to your record keeper, go to your ERISA attorney in getting that stuff answered accurately. And that is it. And let's see if we have any questions.
Great, thanks. That was a lot of information. So thanks for breaking it down. I think it's a lot to digest for everybody. So can you summarize what should employers with and without plans, what should they be doing now?
Wow, employers with plans should definitely be looped in with their record keeper, with the account manager for their 401k plan at Fidelity, Empower, whatever company they're working with, John Hancock, whatever it may be, and just sort of saying, hey, what's coming down the pike? Are there going to be amendments we can implement? Are we going to be rolling out some of these features before we even amend the plan and do retroactive amendments? What are my options right now? What's on the menu for me right now under Secure 2.0? Can you implement any of this yet? Also, they should be talking to their employees and, finding out, looking at their population with student loans if they have that data, looking at their enrollment data and whether they might benefit from offering a de minimis incentive. They might benefit from offering the match on the student loan contribution. So I would say turning to their record keeper, third-party administrator, plan advisor, and also turning internally to their participation and employee census and trying to bridge the gap. And if they don't have a plan, I would definitely be looking at my network of financial advisors and maybe connecting with somebody who specializes in 401k plans and saying, like, what can you do for me? What are some of these tax credits? What are some of these simplified plan designs? What are some ways that I can, brand a new plan, attract new employees, keep valued employees under roof with a plan, and maybe have the government help me pay for it while I go about achieving that objective.
Okay. And we didn't mention it, but I know Linda's putting some information in the chat right now. She put in some information that if you have any questions, to please drop them into the Q&A section right now. And she also put the survey back in again for people who are looking for HRCI credit. So you just went through what a good thing for employers to do now, whether they have a plan in place or not. But what if you're in CalSavers? Do you have to start a new plan if you're in CalSavers, or what does someone who's in CalSavers have to worry about?
That's a great question. And no, you don't have to start a plan. If you do start a plan, you're going to make yourself exempt from CalSavers, and you want to go through the exemption enrollment process or the exemption prove-up process online with CalSavers. It's not generally doable to have CalSavers happening when you have your own plan. That's a question's been asked me before. It's sort of they're two alternate universes. And if CalSavers is working for you, and you don't feel that your business can be advantaged tax-wise or in terms of employee attraction, retention by a tax qualified plan of your own that's branded with your business's name, then keep on keeping on. But if you feel like CalSavers is just sort of a mandate that doesn't help you achieve any tax goals, any employee retention attraction goals, then think about some of these plans, especially with the new, federal money to help subsidize the cost of starting them up and making employer contributions. I think CalSavers is not going to change anyone's life anytime soon. It's great for people who truly fell through the cracks of the system. It's going to get them a little bit of retirement savings sooner rather than later. But you can do so much with a 401k plan, especially now with the student loan ability, the Rothification. There's just so many features that you can tailor to your business's needs and your employee population's needs. And the 401k plan also gives you a really good opportunity to face your employees with something that's for the business's benefit and for their personal benefit. It's a totally positive discussion about, how do we make this work for you? I think employers are always looking for common ground they have with employees that serves both the businesses and the employees' individual interests. And I think 401k plans are one of the most tried and true ways to do that.
Let me jump in on that as well, Christine, because I don't think that CalSavers does much of anything. Employees pay the fees and like return rate's so low and things like that. And I think a lot of employers, especially some of our smaller employers, don't realize it's pretty inexpensive to start a 401k plan. You don't have to do a match. And for about $2,000 a year is all it takes to have a 401k plan. So at least for small employers. So if anybody out there doesn't have one right now, you're in CalSavers, you've been reluctant to start one because you think it's too expensive, reach out to us. We can refer you to some of our partners who work with small employers to get a plan in place, and it's pretty painless.
Yeah, I mean, it's free. Under Secure 2.0, it's now free basically to set up a 401k plan. The only hitch is going to be when you get to that 100 participant or more threshold, but there's so many businesses who will never get there.
Right.
And to be defaulting into CalSavers and missing this opportunity. Of course, we're preaching to the choir because we get an audience with their own plans. But like I said, if they're advisors or they work with multiple businesses and they see them sort of missing out on this phenomenon, then and I personally noticed, because I'm watching the retirement plan press constantly, that the concept of financial wellness, the concept of unpreparedness for retirement, the concept of saving often and early is getting increasingly loud. And what for, the 401ks have been around since the 80s, and they really were sort of ignored and really weren't doing a whole lot for anybody but Wall Street for many, many years. But now everybody is like, whoa, I think it's baby boomer, the late baby boomers and Gen X now kind of getting towards retirement, I think everyone's like, whoa, we really need to do something. And so the focus on financial wellness and retirement savings is going to get nothing but louder and more prevalent. And I think employers want to have an answer to employees about why they don't have a retirement plan, increasingly in coming years.
Well, especially with how difficult it is to attract and retain talent, right?
Absolutely.
It's a competitive advantage if you have one.
Yeah.
And it could be a deterrent if you don't.
Absolutely.
Great. We have a multi-part question here on the student loan repayment option. So you just mentioned that option. Is the ER match pre-tax or post-tax? I'll give you that one section first, and then we'll go into the rest.
Well, I mean, an ER match is always going to be pre-tax unless you are making use of that Secure 2.0 option for employees to request Rothification of the employer contributions. I can imagine both of those features of Secure 2.0 being combined, where you're matching a student loan and the employee has asked for it to be Rothified, but I've not seen anything in the retirement plan press talking about the overlap of those two provisions yet. So in most instances, it's going to be pre-tax.
Okay. And if like you said, this is new, so you might not have all the information on this yet, but if the amount of the student loan payment exceeds the ER match percentage, what amount is provided? Is the amount equal to the loan repayment amount, or is the contribution capped?
Those are great questions. And really what happens is I think it can be a separate defined match for student loans than it is. Let me correct myself. I mean, basically you would apply your matching provisions to the student loan as if it were a deferral. And so, for instance, if you deferred 50% up to 3% and somebody had a student loan repayment that was equal to 6% of comp, they'd get the full match. It wouldn't have any, it would be a formula just the way it is in the regular plan. It wouldn't have to match the loan repayment or have anything like that. You're allowed to define the formula you're going to match just the way you can with the plan as a whole. I don't know if that answers the question.
If not, they'll have your number to reach out to you. So that's the thing with the questions that come in. Some are very specific, and we can only address what we can here, and they have the information to reach out to you. What about a religious organization? We are a religious-based or exempt organization with 22 employees. Does any of this, will that apply to us?
If you're a true, what they call a steeple church, like you are, an Episcopal church, a synagogue, a true steeple organization, then you're probably exempt from ERISA. I don't know what specific provision you're talking about. Secure 2.0, because Secure 2.0 amends the Internal Revenue Code as well as ERISA. So Internal Revenue Code provisions and features in plans could still apply to you. It depends on what kind of plan you have and what features in the plan are impacted by the Internal Revenue Code and still applicable, and what stuff you might be exempt from because you're a church. So hard to know specifically what would apply and what wouldn't. But even though I'm very specialized in being a benefits attorney, church plan attorneys are an even more specialized subset of practitioner. And so if you truly are a steeple church organization or church affiliated, I would recommend you seek out somebody who has real expertise advising churches and governments about their retirement plans.
Okay. What's a good source to keep up on all this retirement legislation from a planning administrator standpoint?
Well, I've got a blog called E4ERISA, EFORERISA.com, that I post regularly on Secure 2.0. That's one option. I would say that if you're, you would maybe talk to your record keeper or third-party administrator about what resources they have. A lot of third-party administrators have a whole library of information about retirement plan legislation online. The Fidelities, the Empowers of the world have a lot of information for plan sponsors and for participants. They have it tiered for plan sponsors. They have it tiered for participants. So that might be a good source. The IRS itself isn't great at making this stuff really digestible, but Morningstar, Forbes magazine online, there's an organization called ASPA that is has a lot of information about retirement plans. So that's I would start with my third-party administrator or record keeper, because you're paying them to kind of help you navigate the world of retirement savings. And I would start with their resources first. And if they're not sufficient, I would ask them to get you even deeper into learning on that front.
Okay. We've had a couple of people ask you just to repeat the website for your blog again.
Sure. It's www.eforerisa.com.
ERISA.com.
Yeah, I've been maintaining it since 2011, and it kind of started with the Affordable Care Act, and but it's got tons of retirement plan stuff there, a lot of stuff in Secure 2.0, and there's and on my blog there's a blog roll of other places to find information, so that you might be able to sort of toggle over from there. Yep.
Perfect. Linda put the information into the webinar chat in case you missed that.
Thank you.
The last question. Oh, sorry.
I was just going to say, there's a way to subscribe by putting your email in. And so when I post, which is about every month to 6 weeks, you'll get an email, but it's only every month to 6 weeks. I'm not one of those people who's going to pepper your inbox. We all have been there, done that, and I'm not one of those people.
Okay. We have just about a minute left. I have one other question, and it's on the Saver credit. What is the IRS publication number that explains this credit in more detail? Is that something that you have at your fingertips, or something?
I do not. I don't know the IRS publication that explains the Saver credit, but I would, if it were me, the ERISA attorney who's been to law school, wanting to find it, I would literally go into Google and I would put Savers credit IRS publication, and you're going to find it. It might even be discussed in the instructions to the 1040, but that would be my best guess.
Okay. Thanks. That's our question. So I'm going to turn it over to Linda.
I was just going to ask Christine to move to the next slide so everybody can capture your contact information.
Oh, sure.
Christine obviously is a wealth of information on this. This stuff makes my head want to explode. So glad to know you. And thank you again so much for coming to share your expertise with everybody on the webinar today. Denise, thanks as always to you for moderating. And again, this recording will be posted on our YouTube channel, which is youtube.com/ethoshcs for Human Capital Solution.
Thank you so much for this opportunity. And I do love to work with employers to keep their plans healthy and happy, and with advisors who work with other plans and not just employers themselves. So look me up if need be. And again, thank you for this opportunity.
Thank you so much, everybody. Have a great day.
Have a great day. Thank you.